So, is my voice is clearly audible?
Yes, sir.
Okay, thank you. So, in the last session of this subject, international finance, actually, we see the currency, why we can say the need of the convertibility to the different currencies, what and how the exchange rate we can say calculated on the international level, so that we are going to study in these sessions. That is, I think in the last sessions we see what is the global financial markets. Okay, so we covered that part. We also understand the global financial market is some of we can say global financial market. Okay, we understand. We know that we can see the summation of the stock exchange at the international level is the 106 trillions. That means the you can say is near about the 3.5 times of the American economy. Okay, so the we can say the largest market on the international level is the we can say the derivative market. Okay, so because of in the hope of the maximum return, we can say the speculators and the investors they actually we can say majorly invested in the derivative market. Okay, we understand the interest rates and its impact. Okay, and we also can say
हॅलो सर, आवाज येत नाही
who
तुमचा. हॅलो हॅलो
decides the
हॅलो
interest
हॅलो
rates. That we also see
हॅलो
that the central bank of the country who decides uh, just a few minutes, students. There is some technical error. I'll rejoin.
येतोय सर, सर आता येतोय आवाज.
येतोय clear?
हो सर, आता येतोय क्लिअर.
Okay, okay, fine. Okay, so what we learned once a minute, I'll share the screen and they will start. Okay, we see the currency convertibility on the international level, so that we are going to understand in this session, that is the currency concept. What is how the currency we can say convert at the international level. Okay, see, we are going to understand what currencies and the different types that exists globally, how freely the exchange is the fundamental to the international finance and trades. Okay. uh, I also told you that part also, that is what are the type of different currencies, that the currencies issued by the different central banks of the nations, that is the, we can say, the paper printed currencies, that currencies we call it as the fiat currency. Actually, it is the government issued currency. That means it is the authorized currency by the government and the central bank of the every country. For example, if you say why we exchange rupees with the different goods and services in India, because the Reserve Bank of India and the Indian government authorize the piece of paper, that is rupees, to exchange the different goods and services. So that is the example of the fiat currency. Actually, next one is the commodity backed currency. What we say that gold, silver, we can consider. We know that before the times of the paper currency, in the traditional trading, actually the some of the valuables we use as a currency. That is, we can say gold, silver, diamonds, platinums. So all these we can say the precise metals we used as the currency. Okay. So when I convert my paper currency, when I purchase these valuables with my paper currency, so my paper currency converted into the, we can say, the commodity currency. For example, like the gold, silver, this all these we can say actually before the 1971, before the we can say when the paper currency came into existence, actually these valuable metals we used for the exchanges of the trade on the international level. So next currency is, we can say, the digital currency now, as to save the environment, or we can say for the convenience of the payment. Okay, it is the main motive of the digital currency. That means if I want to make the payments on the international level, across the border payments, no need of the paper currency for this payment, because I no need to keep the paper currency in a suitcase. Okay, and no need to physically we can say travel to any particular nation, and no requirement of the physical delivery of the paper currency. Okay, so whatever amount, whatever we can say the money is in my account in the form of we can say digital currency, I can directly transfer that currency to the another party of the other nation. So that is a digital currency. So some of the example of the digital currencies here, that is, we can say, the cryptocurrencies, okay, bitcoin. So these are the form of the digital currency. Okay, so whatever amount you have in your mobile phone, that is your balance is in the UPI, in the form of UPI. So it is all these the digital currency. Okay, whenever you buy something in open market, when you buy the groceries, when you buy the vegetables, okay, when you make the payments with the help of the UPIs, that is Unified Payment Interface. You can make the payments with the help of Phone Pays, Google Pays, Amazon Pays. So all these type of the platforms which actually provide the facilities to transfer the digital form of currencies. Okay, so these are the, we can say, the functions of the currencies. Now, how we can say that part also we cover, that is the currency convertibility. Actually, we I think we are at the point, that is the how the exchange rate decides how the one currency exchange into the another form. Okay, so we are going to understand in this session, that is the exchange rates are determined the relative value between the currencies. Okay, between the two different currencies of the two different nations. Okay, now so that rate is decides. So that rate we called it as the exchange rate actually. Okay, so the we can say for the for two different currencies, there is the we can say the different exchange rate. For example, if you take the rupees and dollar, rupees and euro, rupees and yen, rupees and Australian dollar. So all these currencies, for these five different currencies, so there are the four types of different, you can say the five types of different exchange rates. Okay, so this is how now we are at the point. So how this exchange rate decided actually on an international level. So that we are going to understand in these sessions. Okay, we can say what is mean by the exchange rate. What are the basics in the exchange rate that we are going to understand in this topic, that is exchange. What is exchange rate? The definition is given here. Is the exchange rate is the price of one currency expressed in terms of the another currency. Okay, because okay, when I want another currency, how much I have to pay, that rate we called as actually a exchange rate. That means the price of one currency. If I want a dollar, we can say uh, on behalf of rupees. So how much rupees I will have to pay to get a $1? So that rate we called it as a exchange rate actually. For example, here is one example is given to us, that is one US dollar is equal to 0.85 euros. That means $1. That means if the European peoples wants the $1, they have to pay the 0.85 euro to the another party. Then automatically they gets the one US dollar. Okay, but we can say the value of euro is much stronger as compared to US dollar. But it is not in case of Indian rupees. We if we see the today's value of US dollar as compared to the rupees, it is actually the 88.05. So it's the huge value. Okay, so how this exchange rate decides? Okay, if you see before 6 months, the value of one US dollar is equal to near about the 82 rupees. That means now after the 6 months, the value of US dollar increased by the 6 rupees. Okay, so how this value changes as a time? Okay, or how this value decreases as a time? Also, okay, who decides that exchange rate? So that we are going to understand in this sessions. That is, there are the two types of methods of the exchange rate. That is the direct quotation methods, and we can say the indirect quotation methods. Okay, so the amount of domestic currency per unit of the foreign currency, it is the direct method. That means if we convert the Indian rupees directly into the another currency, when we convert the rupees into the dollar, into the euros, into the, we can say the pounds, you can say into the yuan, into the any other currencies. So that we can say conversion we called as a direct conversion. We can say direct quote. Okay, so when the amount of foreign currency per unit of the, okay, what is mean by the indirect quote? Then when we convert the other currencies into the Indian rupees, so that we called as the indirect quote. Okay, so so if you work in, we can say in Japan, so when the yen convert to the other currency, it is a direct quote. And when we convert the other currencies into the yen, then it is the indirect quote. So it is the basic difference between these two quotation methods. So exchange rates are actually determined by, I already told you how the exchange rates on the international level decides. Actually, the market forces, there are the two important market forces, that is the demand and supply. Okay, whenever we think of the goods and services, we know you guys are already learned that in the subject of economic analysis and business decisions. Okay, these two forces, that is the demand and supply. Okay, you already learn the law of demand, law of supply. Whenever there is, we can say there is an increase in price, there is a decrease in demand. Whenever there is a decrease in price, there is an increase in demand for that particular product. Okay, so it is we also you guys also learn the law of supply. Okay, whenever there is an increase in price, the supplier increases the supply in the market. So automatically Whenever there is an increasing price, supply for that particular goods or service in the market gets increases. Or whenever there is a decrease in price, we can say the supplier thinks that now he'll gets the low price for that particular product into the market, so he reduces the supply. Okay, so whenever there is a decrease in price, the supply for the particular product, good service in the market gets decreases. Okay, so these two forces, that is the demand force and the supply force, as per the prices for the goods and services decides into the market. Okay, for example, why the prices of the apples in the market are so high? Because the demand for the apple in the customers is a huge demand, and because of the demand, the prices for that product is the we can say at the higher level. Same like that, whenever the demand for the any currency on the international market in the international level is we can say is higher, automatically its value at the international level is high. Okay, as per this criteria, the value of the one currency, we can say the exchange rate decides. Okay, so the exchange rates are determined by the supply and demand dynamics in the forex market, the world's largest and most liquid financial markets. Okay, so the exchange rates are continuously fluctuates based on the market forces. We know okay, every time the demand and supply of the currency in the international markets gets changed, and that's why you see the exchange rates in the morning is different, exchange rates in the afternoon is different, exchange rates in the evening is different. Okay, so why this is? Because of the exchange rate decided by the two different forces, that is the demand and supply force. So this is how we can say the exchange rates on the international market of the different currency decides. Okay, we can say what are the different types of the exchange rates. Okay, there are the we can say the three types of uh, exchange rates. Okay, if the exchange we can say the exchange rates are only determined by the forces demand and supply, we can say the exchange rates are freely determined. Okay, so there is a no control of any regulators, any country on the exchange rate, so that exchange rate we called as the floating rates. Okay, so as per the market forces, that exchange rate decided by the market itself. There is a no intervention by any third party to decide that exchange rate. So that rates we called as the floating exchange rates. Okay, so the floating exchange, we can say the value determined slowly by the market forces, no government intervention. Okay, so no government intervene in the exchange rate. Okay, so we can say the market forces itself decides the exchange rates. Example, the US dollar, euro, Japanese yen, British pounds. Okay, so all these we can say the price fluctuates constantly based upon the trade flows, investment, and the speculations. Okay, and the demand and supply of the currency on the international level. So this is how we can say the floating rate decides on the international level. Now, what we can say, the some of the nations uh, they wants to reduce the risks in the international trade. Okay, they know that whenever they pay the payments on the floating exchange rates, if the exchange rates gets higher, so at that point of time they know that they have to pay the highest higher amount. So what the government do? Government fix their currencies exchange rate with the different currencies. Okay, we mutually decides the fixed exchange rate. So that what we called as the fixed or the page rates. Okay, so the government commits to maintaining a specific exchange rate against the another currency or the basket of currencies. Okay, so how they decides? they mutually decides. If we can say the US president or the prime minister of India, if they took a meeting and they decides that the 20 US dollar is equal to the 20 rupees is equal to 1 US dollar for next 5 years. So it is a mutual understanding. Okay, so they can make a contract like this, and they can fix a exchange rate for next 5 years. So we can say, but it is, we can say it is the government's commitment with each other. It is a mutual contract between the two different countries. It is, we can say, a mutual understanding between the two different countries. So actually, in fixed or the page interest rates, the government actively intervene to determine the exchange rate, but it is not in case of the floating exchange rate. So in floating exchange rate, we can say the no government, no any third party, no any financial institution intervene while determining the we can say the exchange rate. So that rates we called as the floating exchange rate. We can say the floating exchange rates are more beneficial to the rich countries, to the developed countries, because the value of their currency, the countries like US, they already know that they are dominant in the world economy. Okay, because they are the richest country. They are, we can say, uh, uh, the US economy is the 30 trillions economy. So no one is near to that economy. So they already know that their currency, that is the US dollar, is the dominant currency in the market. So they know that they fixed the currency exchange rate with the other countries, they'll get the advantage. Okay, so the this type of rich and the developed countries take the advantage of their dominance in the world economy, because they know the demand for their currency for the international trade on the international market is higher. So that's why this we can say this country not go with the fixed rate. That is, they are not make any mutual contract. We can say with the other currencies. Okay, so these are the two types of, we can say, the exchange rate. Now next one is the managed float. Okay, this means it is the combination of the fixed exchange rates and the floating exchange rate. It has, we can say, the managed float. That means the market determine, but with the occasional central bank intervention to limit the excessive volatility. That means the exchange rate decided by the market forces, that is the demand and supply. But whenever the government or the we can say the central bank thinks that now the value of their currency is gets decreases below what the expectations they have. Okay, at that type of time, uh, guys, please unmute your voice, because okay, so there is some disturbance. So please unmute yourself. Okay, so whenever the central bank thinks that they we can say have the losses because of the higher exchange rate with the other currencies. So at that point of time, they intervene and they minimize the risks. So that we can say that exchange rate we call as the managed float. That is the combination of fixed exchange rates and the floating exchange rate. We can say now the exchange rates around the world, how the systems, we can say the exchange rates develop over a time of period. Okay, so I already told you that before the paper currency come into existence, we know that the trade on the international levels were done with the help of some the commodity currencies. Commodity currencies like gold, like silver, like we can say the platinum. So these are some, we can say, the precious metals in which the trades on the international levels, we can see the payments done with the help of these precious metals. So before the 1944, there is we can say there is a no the exchange rate systems as uh, today we see. So these systems we call as this is the gold standard era. That means the currency is valued in terms of gold. I told you in the some previous sessions that that 20 dollar is paid to the 1 ounce of gold. Okay, and then we can say whenever I want to convert my currency into the dollar, I we can say I need to buy the 1 ounce of dollar, and then I sell that 1 ounce of dollar to the person who has the dollar currency. Then I'll get the dollar. So this is how the conversion happened on the international level. That means the currency is value in terms of gold, then creating the fixed exchange rate between the countries and abandoned during the okay. So first we can say the currency is paged to the gold's value. Okay, so before we know there are the this is the fixed exchange rate of the different currencies in terms of gold. Okay. Okay, so then we can say the Bretton Woods systems come into existence between the 1944 and 1971. We can say the fixed but adjustable page interest against USD with USD convertible to gold collapse when the US ended the gold convertibility. Okay, so before in between the period 1944 and 1971, as I told you, the $20 is equal to the 1 ounce. 1 ounce. So like this, the US convert uh, into the different currencies. So this is we can say the fixed plus adjustable paid. Okay, but during this period, what US thought that the demand of their currency on the international market is higher. Okay, so they'll get the more advantage if they goes to the floating exchange rate. Okay, because they know because the each and every country now accepted a dollar as the payment. Okay, so post Bruton era, that is it, from the 1971, the major currencies float freely. Now the every currency is of exchange rates determined on the international market with the help of we can say the float rate. Okay, that means the exchange rates decides by the market forces, that is the demand and supply. Okay, so the major currencies float freely while some countries maintain the various form of the managed exchange rates. Okay, so the trend since the 1971 has towards the more flexible exchange rate arrangement through many emerging economies still maintain their currencies to the varying degrees. Okay, so this is we can say the scene. This is how the currency exchange on the international level, and this is how we can say the different. We can say the currency exchange systems we learn, and we also learn the how the systems of the exchange rate get changes over the period of time from the we can say from 90s to 2025. So all these we understand. Now the demand and supply of the foreign currency, we understand the how the value to any currency decides, how the value of the any currency is decides on the international market. So it is decided by the two forces of the economic forces, that is demand of that currency and supply of that particular currency into the market. For example, if I say the demand of the US dollar in the international market and the supply of the US dollar in the international market, so that demand and supply decides the exchange rate of US dollar with respect to the different currencies. So this is how the value is given to each and every currency. Like any market price, the exchange rates are determined by the forces of demand and supply in the foreign exchange markets, influenced by the numerous economics, political, and the we can say the speculative factors. Okay, so this demand and supply of the currency is influenced by the different factor. That is, we can say one of the factor is the economical factor. That means we can see the rich countries, developed countries. Okay, so their economic conditions automatically affects the demand of that particular currency in the market. So, okay, so these countries which are the those are doing the economically well, automatically their demand for their currency on the international markets gets increases. Some of, we can say, the political factors. Okay, if there is a we can say the instability in the any country, automatically the economic slowdown we found in that country, and automatically the demand for their currency on the international market gets decreases. For example, if you take after the World War One and World War Two. So, okay, so there are two major we can say the world power. Okay, so there are two major financial power in the world, that is the America and Russia. That means these two power are the near to each other. We can say with respect of the economic development. Okay, with respect of the valuation of their GDP. Okay, but we see okay, so American we can say America is the politically stable country from their independence. Okay, so they got the independence in their 70s, near about the 3000 year backs. Okay, so they adopt the, we can say, the democratic systems in the United States, and their government is, their systems is very stable in the US. So automatically, the, we can say, the business favorable environment we found in the US, and the US becomes the number one economy in the world. But we so we if we see that Soviet Union, the same likewise the name of the United States is the United States of America. That means the 50 states came together and they makes the one country. Same likewise the US USSR, that is, we can say, the United. Let me check. Actually, I told you. I don't recall that full form of the USSR currently. That is the United States of Russia, something like this. So whenever I recall, I told you that. So USSR also the we can say the union of the different states. So in their 90s, the USSR break into near about the dozens of countries. That means these we can say the political instability affects the economic development. We can say the overall GDP growth of USSR, and we see that Russia, we can say uh, loss is we can say the status of the world power. Okay, so now US uh, from the year 200 or 1995. So US is the, we can say, the sole world power in the world. So this is how the political scenario affects the demand and supply of the foreign currency in the international market. Okay. So now next one is, we can say, the some of the speculator factors. Okay. So these also have the we can say impact on the we can say the demand and supply of the foreign currency. Now, next point are, that is the driving forces of the foreign currency demand and supply. So, which are the factors which decides, we can say, the currencies demand and supply on the international market? Okay, so we can say the first point is, we can say, the trade flows. Okay, so the import and export. Okay, so we know that in trade there are two types of transactions we seen on the international level. That is the imports and export. That is, the imports are creates the demand for the foreign currencies. Okay, whenever we want to import something, whenever we want to import the oil, energies, okay, some technology, okay, some of the we can say the advanced cars, okay. So such a type of goods and services whenever we required, we have to make the payments in the foreign currency. Okay, so whenever any currency imports something, that import creates the demand for the foreign currency, because to pay to the suppliers, okay, to make the payments to the suppliers. So whenever we can say we export something. Okay, so whenever we export the masalas, whenever we export the clothes to the other countries, whenever we export the grains, okay, whenever we different fruit like the mangoes, oranges, okay, so that we produce in the abundance quantity. Okay, so that whenever we export that, that generates the supply of the foreign currency. That means the we receive the foreign currency. Okay, from the overseas buyers. Okay, so to whom we supply that goods and services. Okay, so the we can say the trade flows creates the demand and supply for the currencies. Okay, this is how we understand the trade flows. We can say creates the demand and supply for the currencies. Next one is we can say the capital flows. Okay, whenever the capital or the investment flows from the one country to the another country. For example, if we say the foreign direct investment, okay, if we can say the any foreign institutions, foreign individual investors, okay, any foreign multinational company, multinational corporation invest in India, okay, so that type of investment we called as the foreign direct investment. Okay, so they directly invest in the we can say in Indian region. So because of that, because it is the capital, we can say foreign capital flow, foreign investments. That's why we called as the foreign direct investment. So that foreign direct investment creates the demand for the local currency when foreign companies invest. Okay, as we know that whenever the foreign company, foreign multinational corporations invest in the region of India. Okay, so they bring the dollars, because but in Indian region, uh, our currency is rupees. Okay, so though no one as we can say accept dollar to exchange the goods and services. So what first need to do by the multinational companies? They need to do convert that foreign currency into the Indian rupees. Okay, so then they can use these Indian rupees for their different expenses, expenditures. Okay, to we can say manufacture the different goods and services. Okay, so foreign direct investments creates the demand for the local currency actually. We can say the portfolio investments. Okay, the purchase of the stocks and bonds affects the currency demand. Okay, so whenever we purchase of the stocks and bonds, that actually can say the create the demand and supply for the foreign currency. If I purchase the any foreign stocks, okay, first I need to convert my rupees into the dollars and then I make the payments. So the portfolio investment also we can say creates the demand and supply of the for the any particular currency. Next one is we can say the speculation and intervention. Okay, whenever the traders trade on the international level, that is the forex traders, we can say the speculator takes the position based upon the expected currency movements. Okay, so speculators we can say are those investors who actually take the advantage of the price difference between the two different markets. Okay, so what speculator do? Speculator buys the currency in one market at the low rates, and then he sells that same currency into the another markets at the high rates. And the difference, the price difference between the two market is the profit margin of the speculators. Okay, so this is how speculators creates the demand for the demand and we can say creates the demand and supply of the currency on the international level. Okay, to we can say for his profit, the speculators creates the demands actually. Okay, we can say the central bank buys or sells the currencies to influence the exchange rate. Okay, actually, the central banks, if I say if we can say RBI, RBI wants to reduce the value of the dollar as compared to rupees. Then what RBI does? RBI increase the supply of the dollar they purchase into the market, and whenever he increase the supply into the market, automatically whenever the supply increases, the value of that currency gets decreases because it's easily available now into the market. So this is how the central bank actually we can say influence the exchange rate. Okay. Uh, each and every central bank does the same thing. Uh, Whenever their currency we can say weak as compared to the other currencies, they increase the supply of that particular currency into the market, and automatically their own currency get we can say strengthen on the international market. Okay, so here one real world example is given to us during the 2023, the global uncertainty period, the investor flocked to US dollar as the safe haven assets, driving up the demand, and we can say strengthening the US dollar against the most major currencies despite the US economic challenge. So in 2023, what happened? There we can say there is the we can say the global uncertainty period. We know that there are some pandemic period. Okay, it is the post-pandemic period. Okay, so the wars are going on the international levels between Russia and Ukraine, between some of the major nations like we can say uh, Israel and Gaza. Okay, because of all these, US political condition is very stable. It is the rich and developed economy, and despite of some economic challenges, the investors we can say thinks that US investments in the US dollar is the safest investment. And because of this, what happened? The demand for the US dollar on the international level increases, and because of that increase in demand, the value of the US dollar on the international markets gets decreases, so automatically the exchange rate of the dollar with respect to the other currencies gets increases. So this is how we can say the demand actually influence the exchange rate value on the international market. Okay. So this is we all understand the actually the this is how the exchange rate decides. Okay, so we will also see one video I will share with you guys. So we you can understand also we'll you also have the more clarity of the exchange rates. I try to share the video with you. Uh, just have some patience.
Hey there. So, this is Bob. He lives in America, where he uses the US dollar almost every day. Now he wants to travel to Germany, which uses the euro as its currency. But when Bob tries to exchange his money, he finds that 1 US dollar is equal to 90 cents euro. Then Bob goes to Vietnam, where 1 US dollar is equal to 25,000 dong. Wait, hold on. Why does money have different values? Why isn't 1 US dollar equal to 1 euro and 1 dong? And why do exchange rates keep changing every second? In this video, we're going to dive into the world of currencies, exchange rates, and why money isn't just equal. Before we talk about the reasons behind different currency values, let's first cover a short history of currency. For a long time, money was directly linked to precious metals like gold. This was known as the gold standard. Under the gold standard, a country's currency was backed by a certain amount of gold.
ये सब मेंटली चैलेंज है, हाथ वगैरह चलता नहीं है, दिमाग काम नहीं करता है। इनको माँ बाप रेलवे स्टेशन बस स्टैंड में छोड़ के चले जाते हैं।
For example, the US dollar was once tied to a fixed amount of gold. This helped keep exchange rates stable because a country couldn't just print more money without having more gold. It stopped governments from printing too much money. But as economies grew and global trade expanded, countries started moving away from the gold standard. It was getting harder to keep enough gold to back every unit of currency, especially during wars and crises. By the 1970s, most countries had switched to a new system called fiat money. Fiat money is currency that has value because the government says it does, and people believe it. It's not backed by any physical asset like gold. That's why some people call it fake money. If you want to learn more about this, let me know in the comments section, and I can make another video for it. As fiat money has no physical value like gold, its value depends on whether people still want it or not. If many people want the money, they will compete to get it, making the value of the money go up. But if nobody wants the money, its value goes down. So, the value of fiat money comes from supply and demand. That's why the currency of strong economies like the US dollar is higher in value because more people want it. Meanwhile, the currency of weaker economies, like Venezuela, which had hyperinflation, is much lower because nobody, not even Venezuelans, wants it. So in this video, we will look at how supply and demand affect the value of money. Section 1. Inflation. So, inflation is when the currency starts losing its value. Simply said, it's where there's more money compared to the amount of product and service. You can watch my video about why don't we just print more money to understand more about this. So, when a country has high inflation, its currency's value will decrease. Why? Because nobody wants to buy and hold a currency that is losing value. For example, in 2022, you can buy 2 loaves of bread for $10. But due to high inflation, 2 years later in 2024, you can just buy a loaf of bread for $10. So you buy fewer things with same amount of money. A real-life example is Zimbabwe. In the 1980s, the Zimbabwean dollar was worth more than the US dollar. One Zimbabwean dollar was equal to 1.35 US dollars. But due to their failed land reform, economic problems, corruption, international sanctions, and printing money mindlessly, the value of the Zimbabwean dollar dropped dramatically. By the 2000s, 1 US dollar was equal to almost 600,000 Zimbabwean dollars. The government tried to fix it by changing the currency several times, but in the end, they gave up and started using more stable foreign currencies, like the US dollar and the South African rand. Even though the latest news is Zimbabwe trying to get back their original currency. So +1 point for never giving up to Zimbabwe. Section 2. Interest rate. You might have heard about interest rates before and wondered why they matter so much. Interest rates are the cost of borrowing money in percent. If you borrow $1,000 at a 10% interest rate, you have to pay back $1,000 plus an extra $100 as interest. Central banks, like the Federal Reserve in the US, set interest rates in their countries. When a country has high interest rates, it offers better returns on investments, attracting foreign investors. These investors need to buy that country's currency to invest, which increases demand and strengthens the currency. For example, you want to invest in government bonds. Government bonds are when you lend your money to the government for a set period of time, then the government will return your money with the interest. Let's say you buy a governmental bond for $1,000 with 5% interest for 10 years. It means the government borrows your $1,000 and will pay you 5% interest on $1,000, which is $50 every year for 10 years. So the logic is, The higher the interest rate, higher the return of investment. So, if the interest rate in the US is higher than in Germany, investors might sell their euros and buy US dollars to invest in American bonds or savings accounts with higher returns. This increased demand for US dollars strengthens the currency. On the other hand, if US interest rates are falling, it offers lower returns, and investors might look elsewhere. This reduces demand for US dollar, causing its value to decrease. But a country cannot just make its interest rates as high as possible to attract investors. Why? Remember, interest is the cost of borrowing money. High interest rates also mean it becomes more expensive for people and businesses in that country to borrow money. If borrowing becomes expensive, fewer people buy homes or start businesses. This can slow the economy and lead to unemployment. So, the central bank needs to increase and decrease the interest rate based on the country's situation. And that's why everyone is afraid of this guy when he announces the US interest rate.
Good afternoon. This is the corporate language translator. So when you say
Section 3. Country situation and foreign investment. When China opened up its market in the late 1970s to foreign investors, lots of foreign companies started to open their business in China. If they wanted to open factories in China, of course they needed Chinese currency, which is yuan or renminbi, to buy the land, build the factories, pay the workers and other expenses. So, it just makes more demand for Chinese yuan and make the yuan value stronger and give China lots of money. That's why almost all countries promote their countries to foreign investors and lure them to invest and do business in their countries. But foreign investors won't just invest in any country. They look for countries with stable politics and economies. Why? A stable government means consistent rules and laws for businesses. For example, if a country promises low taxes to attract foreign businesses, but then suddenly raises taxes, it becomes more expensive for those businesses. They could lose money. If a country keeps changing its rules, businesses won't feel safe investing there. Similarly, if there are lots of protests or strikes, it can disrupt production and make it hard for businesses to operate smoothly. A stable economy is also important because it means the country's money is less likely to lose value suddenly. If a country has a lot of debt, high inflation, or frequent economic problems, foreign investors worry they might lose money. So, a stable country is more attractive for investment, which helps keep its currency strong. Section 4. Export and import. When Japan exports cars to other countries, those countries need to use Japanese yen to buy the cars. This makes the yen high in demand. If Japan imports coal from Australia, they need to use Australian dollars to buy the coal, which increases demand for the Australian dollar. Most countries try to export more so that others need to buy their currency, making it stronger. For example, when the U.S. convinced oil-producing countries like Saudi Arabia to sell oil only in U.S. dollars, it made the U.S. dollar highly in demand. Since almost all countries need oil, they have to get U.S. dollars to buy it. This made the U.S. dollar a global currency, strengthening the U.S. economy and influence as the #1 in the world. This is known as the petrodollar. Even though there's rumor that Saudi try to accept other currencies also. I can also make another video about it if you want. On the other hand, small island nations in the Pacific, like Tuvalu, don't have much to export, so their local currencies aren't widely used. Instead, they use stronger currencies like the US dollar or Australian dollar to make trade easier. Section 5. Fixed value. So if you want your country to get stable and strong currency and also doesn't want to be hassle about it, then just use this trick. Just peg your currency to other currency of stronger and stable countries. For example, Brunei, an oil-rich small sultanate in Southeast Asia, pegged their currency 1-to-1 to Singapore dollar. So it means both currencies have exactly same value, and that's why you also can use Singapore dollar in Brunei and vice versa. Another example is Belize, a small country next to Mexico, which pegs its currency, the Belize dollar, to the US dollar. They set the rate so that one Belize dollar is always equal to half a US dollar. So if you want to change your US dollar to Belize dollar, you don't need to see the exchange rate, just double the amount. It's so easy, isn't it? Pegging a currency makes it stable and easy to manage, but the country becomes very dependent on the stronger country's economy. If the US dollar falls, the Belize dollar will fall too. So if one currency lives, the other live. If one dies, the other dies. So, these are some reasons why currencies have different values. Your next question might be, why don't all countries use the same currency, like a world dollar, so we don't need exchange rates and all these hassles? Well, it sounds like a great idea, but it's not that simple. Let's look at the euro as an example. It's very convenient for people living in the Eurozone because they can travel across countries without needing to exchange their money. But the challenge is that every country has to give up control over its own money to the European Central Bank. This means a country cannot change its monetary policy just to fix its own problems because it could also affect other countries. For example, when Greece had a financial crisis in 2009, the effects spread to other Eurozone countries. And that's why Germany is not so happy with Greece about this. So, if all countries in the world decided to use a single currency, it would be very risky. Imagine living your best life, but then facing inflation and a crisis just because a country thousands of miles away messes up its economy. One country's problem would become a problem for the whole world. And maybe your next question is, should we make our currency as strong as possible? The answer is, not really. As you know that different countries have different needs. For example, a country that imports a lot, like Singapore, may want a strong currency to make imports cheaper, while a country that exports a lot, like China, may want a weaker currency to make its products cheaper for other countries. That's why China has been accused of purposely lowering its currency's value, called currency devaluation. How does this work? I'll explain it in another video. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.
Okay. This today we done with the second chapter of the international finance. If you have any questions, then you can ask. You have the 2 minutes, or otherwise, if you don't have any question, then we sum up the sessions. Okay, guys, you can leave the sessions. Okay, so we'll see you in the morning. Okay, thank you.